The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. Silicon Valley Bank collapses. Kiwi companies have $100 million at risk. And beyond that, it's a big week for Wall Street. What will the inflation print say about the US economy? It's Monday the 13th of March and you're watching Markets with Madison. Well, it's already being called the biggest bank collapse since '08. Silicon Valley Bank was the 16th largest bank in America just last week. Now it's in the hands of regulators. A run on the bank is said to be what's caused its collapse, as the bank rapidly tried to raise capital and lost money on US Treasury bonds. The Californian-based bank is known for banking and lending to startups who have billions of dollars deposited with it. One of those is the Kiwi-founded company Rocket Lab. In a statement, Rocket Lab told me it has $38 million sitting with SVB, 8% of its total cash reserves. Crimson Education did bank with SVB. I understand the company ripped all of its funds out just 30 minutes before wires started freezing. Icehouse Ventures Chief Executive Robbie Paul is in contact with other Kiwi startups in the US. Morning, Robbie.
Great to be here.
So what other Kiwi companies could be affected by this and to what degree?
There's a number of companies that are exposed to the Silicon Valley Bank collapse, and that is unfortunate. I would say in the order of $100 million would be exposed across our portfolio and others. So I won't name specifics, but certainly I just want to say hearts go out to a lot of companies who have been sticking their neck out to make an impact on the world and have made the right judgment calls. And they're the fortunate ones to actually have money in the bank. And to have this happen is sort of an unnecessary set of stresses for them.
That's a heck of a lot of money to be caught up in all of this. Are these companies now facing liquidity crises?
I think the one, if you get granular at it, you look at the companies who had all or most of their capital with Silicon Valley Bank, and that's a very small number. And then we'll find out over the coming days, or hopefully day, whether or not a significant portion of their funds could be returned, which would reduce the risk of a liquidity crunch in the near term.
Y Combinator's president, you may have seen, Robbie, said on LinkedIn over the weekend that 30% of startups could fail within the next month and that they'll be unable to pay their staff, meaning up to 120,000 jobs in Silicon Valley could be at risk. Are you hearing similar stories from the companies you're chatting with?
I would say most of the Kiwi companies are fortunate to also have capital in New Zealand or have repatriated some of that capital. So the short answer is no. I don't anticipate any immediate crashes from companies, but there's a very high level of stress with a few of them.
Now, I've also heard from some entrepreneurs that Silicon Valley Bank was viewed as quite accommodating to entrepreneurs domiciled outside of the US. So how did Kiwi entrepreneurs sort of view SVB? Was it a friendly, welcoming bank?
The entire venture and startup ecosystem genuinely appreciated Silicon Valley Bank's role in this world. And anybody who's gone to set up, frankly, any form of an account in the United States will know how challenging that can be. And Silicon Valley Bank filled a gap and helped a number of our companies get over there, get connected, establish themselves, and so on. So it is extremely unfortunate. They carved out a niche. They serve the technology ecosystem very well, and their absence will create a lot of headache for a lot of companies.
Now, there is a deposit insurance scheme in place up to $250,000 protected. Are all of the companies you're talking with, are they part of this deposit insurance scheme? Are they protected?
All depositors are protected to the tune of US 250,000, which is fine, except when you have tens of millions of dollars in a bank account. And typically the ones who are worried are the ones who have significant amounts because they tend to have higher rates of cash flows in and out. There was one that had 268,000 in there. So worst case scenario is they lose $18,000.
But everyone else, that's barely a drop in the bucket, is it?
That's right. Yeah. It comes down to whether or not these companies are able to receive more than the 250,000 up front, and rumors are that they will. And then secondly, what other cash they had in other accounts around the world.
Robbie, what sort of contagion effect could this have across the startup community and also to venture capital firms involved?
Look, the startup and venture capital world is a very thankless world that's faced with a lot of risks, some that are perceived and some that are real. And so to add to the mix, the fact that you can't trust a bank to look after your money. One person explained that being like needing to check each bridge before you drive over it to make sure it doesn't collapse, right? We rely on regulators to look after us in that respect. And it's important to note, I mean, Silicon Valley Bank had 200 billion US under management. It was operating within regulatory bounds. It had been around for 40 years. I mean, it's not that much smaller than the biggest banks in New Zealand. So as far as I've heard, there wasn't any flagrant action, and there wasn't any major deviation from the norms. It's just an unfortunate series of events that have put the businesses that are trying to make an impact on the world in a challenging place.
Enormously unfair. Hey, best of luck to both you and those companies. Please let them know that we're thinking about them at the moment. Appreciate your time, Robbie.
Thanks so much.
Here's some other companies that have publicly said they're affected. Roku, the streaming hardware company, has 26% of its cash held up at SVB, which equates to $487 million US. Circle, a payments tech company, said in a tweet this weekend that it holds $3.3 billion US of its USD coin crypto reserves at Silicon Valley Bank. And Californian video game company Roblox says it has 5% of its $3 billion USD of cash in SVB. That's $150 million US. Now, this has sparked a sell down across other banking sector stocks. According to Reuters, US banks lost over $100 billion US in stock market value in 2 days, and European banks lost around $50 billion US in value. The New York-based Signature Bank and Western Alliance Bancorp dropped more than 30% last week. San Fran-based First Republic and California's PacWest Bancorp both suffered record single-day declines, triggering trading halts for both of those stock. The bigger banks are holding up slightly better. Bank of America and Wells Fargo down by double digits still. JP Morgan Chase down by about 7% last week. All of the major US indices fell around 5% last week. Could be SVB related, but also some volatility ahead of February's inflation. To talk about what's coming up this week, I'm joined by Mark Lister of Craig's Investment Partners. Morning, Mark. Thanks for coming in.
Morning. Happy to be here.
A big week for Wall Street with the US CPI print incoming. What are you expecting?
Yeah, looks, inflation is still the epicenter of financial markets at the moment, and I think what we see on the inflation front in the months ahead will really drive how financial markets perform. So, with these US figures, I think what you will see is the annual inflation rate will continue to taper off. It peaked June last year at about 9%. It's been coming down consistently. This week, I think we'll see it at about the 6% mark. So the good news, it's coming down, but under the surface, I'm still expecting to see evidence of quite persistent inflation in some of those troublesome areas. So I think it will remind us that the job is far from done.
How sensitive is the market to these sorts of prints these days? If it comes in at, say, 6.2, that could really turn things around, couldn't it?
Yeah, it's super sensitive because the level of inflation is the key driver of what happens on the interest rate front, and what's happening with interest rates is really feeding through to all areas of housing and financial markets and confidence. So what we saw late last year, early this year, as inflation was coming down faster than people were expecting, and you saw a bit of a rally. Share markets rose 15% from October through to a couple of weeks back, and this year we've seen evidence of a re-acceleration in economic activity and inflation, and so that's been why you've seen choppiness re-enter. So I think inflation is still the biggest story in markets at the moment.
Producer price inflation. We're also getting a PPI print out of the US this week. What is that? How important is that compared to CPI? How do they work in tandem?
Yeah, well, they are interlinked. The CPI is the inflation that we all feel, consumer inflation. So that's the one that central banks are targeting because that's the one that the average person on the street is being impacted by. Producer price inflation is sort of what's happening behind the scenes in terms of manufacturing input costs and those sorts of issues. So inflation at that level tends to feed through to what happens at the consumer level. And when we look at some of the indicators out there in the world, we are seeing some positive signs in terms of manufacturing input costs coming down and commodity prices coming down, supply chain issues starting to ease, but you've still got areas of the global economy, and in particular the US economy, where wages are still very high, the labour market's very tight. So I think it'll be that CPI print that is the focal point of this week.
Now, last week, Jerome Powell, the chair of the Fed, he testified on Capitol Hill.
Yep.
He made some comments the market didn't quite like. What did
Yep.
he say, and what does that suggest to you about how volatile markets are still this year?
Yep.
Because they're moving on everything that the Fed says and does still.
Yeah, absolutely. And the interest rate outlook is really important. So that's why they're hanging off every word from Fed Chair Powell. And he does this testimony every 6 months, and that's been the case since the 1970s, testifies to Congress. And I think he's noticed some of these issues we're talking about as well. He's obviously picked up on the fact that inflation is picking up again and isn't going down as quickly as he would like. I think what really got everyone's attention last week is the fact that he said that the Fed was open to higher interest rate hikes, potentially, if they need to. Because what we saw last year is we had a string of 75 basis point hikes. I think we saw 4 of them. Then in December, they downshifted to 50. Then earlier this year, they downshifted to 25. So those rate hikes were getting smaller, which was sort of a precursor to them getting to the top of the hill and pausing. So when he now comes out and says, actually, we are open to bigger ones again, that's a big shift in rhetoric from him and the Fed. And that tells you that the Fed's train of thought might have just changed a little bit. So now people are thinking, well, are we back to the 50s going forward? So it'll be really interesting in a fortnight when we next see them make a decision.
I want to ask you quickly about bond yields. We were chatting about this before we came on camera too. That US 2-year Treasury bond yield tipped over 5% for the first time since June 07. How significant is that economically speaking?
That's really important. And the 2-year bond yield at 5%, I guess what that tells you is you can get a 5% return for virtually no risk simply by having your money sitting there in a 2-year treasury. So when you get 5%, which is the highest we've seen in 15, 16 years, when you get 5% just for doing nothing and taking on no risk at all, there's very little incentive to sort of step into more volatile, risky areas of the investment landscape, whether it be shares or property or other assets. So it does just raise the bar for the returns people need to feel that they're going to get to go up the risk curve, which is just another headwind for other areas of financial markets. And it also increases borrowing costs and so forth as well. So it's fantastic if you're a saver, if you're looking for income, because there's great options available. It's the same story here in New Zealand. But for other parts of the financial markets or for people that have got a lot of debt, it's just a reflection of things getting a little bit more difficult.
Thanks so much, Mark. Nice to have you in here.
Thank you.
Now, if you or anyone you know is impacted by the SVB collapse, please do get in touch. But it's a big trading week anyway, so if you have any other hot takes, email them my way too. Now go put your money to work.
Thanks for checking out our YouTube channel. To stay up to date with all the latest news from the New Zealand Herald, click the subscribe button below or check out one of the videos here. And head over to nzherald.co.nz for more details on these stories and more.